If you could have the same secret tax strategies used by the top 1%, well, now you can. Check out this video. In today's video, I'm going to take you through the key strategies and perspectives that you need to have to not only pay the least amount of tax this year, but to consistently pay the least amount of tax legally required year after year. That's super important because taxes will become your largest expense if they aren't already, if not properly managed. As a consequence of that, by paying the highest amount in tax consistently, small business owners on average pay 40 to 60%, you're slowing down the rate in which you are growing your net worth. And that's really the game we want to play. We want to grow our net worth as fast as possible so that we can live the life that we want. Step one in not only mitigating tax this year, but every year going forward, like the 1% and the top 0.1% do, is you have to have the right entity structure in place. Now, when I talk about entity structure, I'm talking about how the IRS will view you from a tax perspective. The IRS has a few different sections of the tax code that dictate how businesses will be taxed. There are sole proprietors, partnerships, S corporations, and C corporations. Now, you might be saying, Dan, what about LLCs? I hear about LLCs, I already have an LLC, or someone's telling me I need to form an LLC. Well, an LLC is a relatively new construct as far as the IRS is concerned. And LLCs are slotted into the existing structures I described before: sole proprietor, partnership, S corp. So let me explain how that works. Real quick, if you're watching this video and you're thinking, Dan, how could you be my CPA and we could do this all together? Well, go down to the pin link below, description below, click on the first link. That's going to take you to my website where you can schedule a quick call and see if it makes sense to work together. Now let's get back to the video. When you form an LLC and you're the only owner, by default, you're taxed as a sole proprietorship. If you were to have multiple owners, or in the case of an LLC, it's called members, by default, you'd be taxed as a partnership. You can then elect with the IRS to be treated as an S corporation, or you could convert it to a C corporation. Now, there's pros and cons to each of these entity structures, and I'm going to take you through those at a high level. If you were a sole proprietorship, all of your income will be reported on what's called the Schedule C, which is just a schedule within your 1040, your annual filing, your personal annual filing. And you're going to list your revenue and all of your related expenses or deductions, and the difference between revenue and expenses would be profit. That profit is going to be subject to two types of taxes. One is the federal income tax, which are those brackets that are marginal tax rates that increase and they go up to a maximum current rate of 37%. In addition, all of your profit is going to be subject to what's called the self-employment tax. Self-employment tax is how you pay into Social Security and Medicare. See, when you're an employee, you pay in 6.2% of your wages up to a maximum amount that changes each year. You also pay in 1.45% to Medicare. That's unlimited, all wages. There's no caps. The combination of those two, the 6.2% for Social Security and 1.45% for Medicare, equals 7.65%. That's taken out of your paychecks and paid in. Whether when you file your personal return, you could end up with no taxable income. You'll get a refund for the Social Security and Medicare taxes. In addition, when you're an employee, your employer has to match that. So they're also paying in the 6.2% and the 1.45%. When you're a sole proprietor, you're the employee and the employer. So you're paying the Social Security tax 6.2% times 2 and the 1.45% times 2. Collectively, you're paying in 15.3%. That's in addition to the federal income tax brackets. If you are a partnership, because you have more than one member in your LLC, then the tax ramifications are the same. You have to file a separate tax return each year, the partnership return itself, and you get a document called a K-1, as do all the other members in this partnership. They get their own K-1, and the K-1 is sort of like the W-2 equivalent for a partnership. It shows all your share of income that's being allocated to you, any other deductions and credits. To the extent to which you have profits, those profits are going to be taxed just like the sole proprietorship. They're going to get the federal income tax, they're going to get the Medicare tax. So you're paying from your partnership income 15.3% on your partnership income. Now you can elect to become what's called an S corp. Now, to make the election, you file a form with the IRS and you say, I want to now be designated as an S corp. When you become designated as an S corp, You have to file a separate tax return. Now it's called an S corporation return annually. You're also going to get a K1 with your share of profits or losses and any other deductions. But those profits are only going to be subject to the federal income tax. They're not going to be subject to self-employment tax. As an S corporation, you're both an employee and a shareholder. The employee has to draw a reasonable wage, which is based off facts and circumstances, and we have an assessment tool that we use to figure out what the lowest number required is, because we want the lowest wage possible. So that's going to be subject to the income tax and the self-employment tax, that 15.3% rate. Anything after that, your remaining profits, don't get that self-employment tax. So we're really just trying to save that 15.3% tax. So S Corp can make sense typically if you have more than $100,000 in profit per shareholder. S Corp typically is going to make sense to minimize that self-employment tax. It doesn't necessarily minimize federal income tax. That requires other strategies. And then lastly, you could decide to be a C corporation. C corporation typically only makes sense if you're bringing on investor capital, because it's subject to two types of taxes: income tax at 21%, and then your marginal tax rates on any dividends that you take. So for most small business owners, C corporation is going to cause a higher tax rate unless you have shareholders, investors who are requiring you to be in that space, or there's some other factors where you're going to scale up this business, planning for a long-term exit, some other strategies that I will talk about in a separate video. So I just share all those fundamentals with you because when we're talking about designing a system to pay the least amount of tax, you need to be strategic about the right type of entity. Now, what's going to typically make sense and what we recommend for our clients is to form a holding company, typically in the state of Nevada or Wyoming. Why those states? Well, they're one of 7 states that don't have an income tax. So you're not giving yourself exposure to any additional tax. But they also have the strictest privacy rules in the US. We want to think it long term because our objective is to scale our net worth. The reality is people are litigious. So we want to minimize or make it very difficult for people to figure out what we own. So we're going to create this holding company, typically in one of those 2 states, Nevada or Wyoming. That holding company just exists to own our operating businesses. So maybe we have got one business now, that business is owned by the holding company. Maybe in the future we have 2, 3, 4 businesses, or an unlimited amount. All of our share of profits and ownership goes into our holding company. That holding company is going to be taxed as an S Corp. Again, if you have 100,000 or more profit. Why would we do that? Why wouldn't we just have one S Corp? Well, the problem with S Corps is that while it allows you to minimize your self-employment tax, it's not a flexible entity. So if I'm a 50-50 partner with someone, we always get 50% of the profit in an S Corp. Everything has to be what's called pro rata, split based off our ownership percent. But say that I put up all the money and I'm doing most of the work. So maybe we're 50-50 if the business sells, but I want a higher percentage to at least get my money back and account for my time. Well, an S Corp wouldn't allow for that. An LLC taxed as a partnership would. So we can have our individual businesses formed as LLCs, and if there's more than one partner, it's taxed as a partnership. So we have that flexibility. Then everything rolls up into an S Corp holding company that only we own, and that's where we're going to make that S Corp election, minimize our self-employment tax, also run all of our tax deductions through that holding company. Then we don't run into a situation where for our other businesses where we have partners, where we can't do certain tax strategies because they don't agree to it, or they have a different life circumstance than us, and so they're not interested in that strategy. We run all of that through our holding company. So getting that structure in place from the beginning puts you in a position to grow and scale, pay the least amount in tax. Later, you might consider adding in a C corporation for arbitrage. That's for another video, another time. Keep watching because I'm about to reveal the real secret for how the top 1% minimize their taxes. But first, I want to talk about the 4 levels of tax planning. This is a concept and structure that I developed for our clients. And think about it like Maslow's hierarchy of needs. You want to address the foundational things first, continue to ascend until you get to kind of this enlightenment period. This is the most ideal level that we want to get to from a fully optimal tax perspective. Level 1 is capturing all the things that you already qualify for. Someone just hasn't told you about it. And that's likely because you're working with a CPA who's always focused on the past. You don't really have a relationship with them. They don't understand your business. A couple of examples of things you already qualify for. Someone just hasn't told you about it. One is the federal R&D or research and development tax credit. Applies to 48 different industries: chiropractors, dentists, farming, technology companies. It's for developing a new product or process that's technological or biological in nature. They already qualify for that. Someone just doesn't understand your business well enough. The Augusta loophole, which is a strategy that allows you to pay rent from your business to yourself, and the business gets a tax deduction, but it's tax-free to you. Likely, most often, you already qualify for that. Someone just hasn't told you about it, so you're not documenting. That's level one. Level two is turning things that aren't currently a tax deduction into a tax deduction. That would be, as an example, your kids. So kids cost money. There's no secret of that. Thousands, tens of thousands of dollars. Largely don't get tax deductions for your kids. However, if you could come up with a reason why your business could pay them a reasonable salary for work that they're doing, now the business gets a tax deduction, so you get a tax deduction at the highest rate. As long as you pay them the standard deduction amount or less, it's going to be tax-free to them. So now they take the money they're being paid by you and they use it to pay for expenses that you already have. That's a way to turn a current expense into a deduction. The third level are home run strategies. These are things that allow you to reduce your tax liability by up to 100%. In other words, pay no tax. Awesome. Home run strategy that's the biggest example is using losses from real estate. Current rules, you're allowed to use losses from real estate to offset 100% of business income, plus another $500,000 if you file married, $250,000 if you file single. In other income, things like wages, interest income, basically anything that isn't business income. So home run strategies, those are things that take work to implement. And the last thing, sort of highest level of enlightenment, is using structures where all of your future income is going to be tax-free. So now you don't have to find other deductions and strategies because you're generating income that is tax-free. This requires a high level of sophistication and typically requires your net worth to have reached $2 million or more. You can utilize things like private placement life insurance. That's a structure where you're able to contribute a significant amount of money each year, hundreds of thousands of dollars, make investments in other businesses or other activities. That's all going to be tax-free, but without the same ramifications of a traditional retirement account where you have to wait until you're 59 and a half. That's the highest level of sort of enlightenment and tax planning, but it requires building your net worth to get to that point. Old statement, it's easier to make money when you have money. It's absolutely true in this case. All right, now it's time to talk about the real secret to tax planning and the fundamental shift you need to make. We talked about entity structuring. We talked strategically about the 4 levels. Think about your favorite billionaire, Elon Musk, Bill Gates, whoever it may be. Maybe you don't even have a favorite billionaire. Do you think that they find out on April 15th their tax liability? Absolutely not. You think big corporations find out their tax liability when they're filing? They're waiting to find out? Absolutely not. You have a systemic problem in the way that you're managing your finances and specifically your taxes if you're working with an accountant who I call an archaeologist. Most accountants are just focused on the past, just trying to get the compliance work done. So when they say this year, hey, this year's taxes, they're talking about something that happened last year. But those who have the most at stake, billionaires and big corporations, who, by the way, on average pay 0 to 20%, not 40 to 60%, they have more of a CPA, tax planner, who I would refer to as an architect. Based off your goals and strategies, they're building a comprehensive plan for you. They're consistently minimizing your tax bill, and there are no surprises. So it's shifting from a tax archaeologist to a tax architect. Now, how do I know that this is true? If you look at the average tax rate by year for the last 100 years, put it on a graph. Average tax rate, all taxpayers, last 100 years, put it on a graph, it's a flat line. So we've had higher tax rates than we have now, we have lower tax rates than we have now, but the average has stayed the same year after year. And that's because those who have the most at stake, those billionaires, big corporations, They're constantly modifying their behavior to make sure they're capturing the new tax benefits. Tax laws change every year, some more than others. They're constantly modifying what they're doing so they're paying the least amount in tax. That requires you being future focused, building out with an architect the future, not always focused on the past. If you're always focused on the past, you've designed a system that really will guarantee that you pay the most amount in tax. Now, the benefit of what these high net worth folks and big corporations are doing for you, the small business owner, is because they have so much at stake, they are willing to battle out their tax positions with the IRS in tax court. That then becomes public record that we can take a copy. You don't need to take on the risk. They've already done that for you. So what you really want to do is get with the tax architect, helping you to switch your perspective from always being focused on the past to being future focused. And then they're leveraging the court cases as well as IRS audit manuals that are public information so that you can implement those same strategies, but you're going to have less risk than you had before because you're using the information that is public from the tax courts and from the IRS audit manuals. And that's how you play the game like a billionaire. The top 1% pay the least amount in tax. Not just this year, but year after year. This is Dan Nicholson with Unconventional Wealth, and I will see you next time.